Hey everyone, welcome back. It is October 21st. This is Drawbridge Finance. My name is Levi Woods. This is the public live stream, which happens on Tuesdays at 11 p.m., 11 a.m. Pacific Standard Time. Hope you guys are having an awesome day. You can see my sign is green, which is probably a bit unusual compared to most traders out there because that means I'm making money today and the markets are actually slightly down. So we're going to take a look at what's going on in the markets. Everything we talk about here is just my opinion. It's not what I'm suggesting or recommending. It's just what I might do and what I'm sharing with you, sharing my knowledge, trying to get everybody to get rich together. That's the goal. So if you have questions, basic questions about investing, I've been investing since 1996. So I've been doing it for almost 30 years. I've been option trading for a decade and it's been a long journey. And it's part of why I have a trading channel where I get to share my expertise with you. So let's get into it today. We're going to take a look at the markets. I've got Moomoo Financial up, one of my recent sponsors. So we're taking a look at their platform. It's kind of fun. They've got this like world map. It shows, the Asian markets all having a nice positive return. We saw Australia at 0.7% today. We see the Canadian market, which is my market, down 1.78% today. A NASDAQ showing just down negative 0.04%, Dow Jones up 0.69, and S&P 500 slightly green. One of the things that that I like to look at, is the volatility index. And they actually don't have that here on their main screen. So it's one of the important things for me is what is the VIX level, and I do watch it very, very closely. But it has most of the stuff that we need to look at. We've got gold trading down 5.5% today. A nice little move down after 9 weeks of positive returns. Crude oil trading at 57.27 up 0.44%. And what else is going on? Bitcoin up 1.5%, Ethereum up 0.7%, and Cardano up 0.8%. What we're looking for myself is what can we do to make money off individual tickers or the indexes? And I use a different variety of strategies using option trades to do that. And the nice thing about options is I can really limit my loss and I can define a specific amount of risk per trade, which is pretty awesome. But I rely on you guys to help me on Tuesdays because this is a public stream. What I expect and what I hope for is a little bit of back and forth between the two of us. So if you want to drop some tickers down in the chat, then that helps me out. It gives me some direction as to what we might be looking at. Otherwise, I don't have much to say. We've looked at the market. We're looking at what we're doing. Of course, my patrons know all of the trades that I'm putting on right now because they see that live real time in the Discord chat. So I have lots of trades in play. I have about 100 in play right now, and those are constantly kind of getting revised and adjusted all the time. And it's a pretty non-stress way to trade. So if you guys let me know what you're looking at, what you'd like me to look at, I will pull up the charts and we'll take a look at those together. So I'll give you guys a minute to do that. And in the meantime, what do I have here? I've got investing.com open so we can look at different types of companies. One that we're looking at in particular right now is Data Vault AI. Had a nice little move this morning. The fair value is only $1.34, but some of these AI stocks have quite a potential of moving. And if you look over the last couple of weeks, then you can see we've had quite a nice move, up 500% this month. So in the last week, we're up only 14%, but there's definitely some movements in stocks like this. Financial health is not great. These are some of the things that this type of stock is the type of stock that I want to swing trade. I don't like to hold it long-term in my account. These are the types of things we might be looking at. And I hope to see some comments from you guys to let me know what you would like to look at. And what else do I have here? I'm going to pull up another tab of positions that I love to use. We'll take a look at that. This is Seeking Alpha, and we can do the same thing. We can look at DLVT on here and just do a quick comparison and say what is their quantitative rating. And again, the charts are very, very similar, slightly different services, but the quant rating here is a hold. And if we turn myself off here, you can see the profitability is not great. And the valuation is only a C+, but the growth has been fantastic. So it's one of those things where if we're looking at going long, which stocks are good and where could we make some money in those stocks? there's always opportunity, especially with options. So I would love for you guys to let me know. Is my audio working? Are you guys? Is there anybody able to confirm that we have that we're live? We can see anything? Is my audio working? Let's see if we can start a poll. We'll do that and see if you guys can jump into the live chat. Terry says we're working fine. That's fantastic. Okay, so what are we gonna do then? I'll pull up like Trading View. You guys want to look at that? We'll look at my list. I feel like we go over the same thing all the time, but we can do that again and again. So let me get that loaded here for you. Okay, this is Trading View. We're looking at the SPX. If we look at the daily, this is the 1 minute chart. What's happening today? We saw a little bit of a sell-off, but we're very much staying in range over the last little while. We're at the top of the bands. So if we were to flip this over to a different view, we'll just take a look at the 1 day chart and you can see where we are with the S&P 500. We're very much at the top of the channel. NQ, similar sort of thing. They're very highly correlated. Russell has come down a little bit, but it's also at the top of its channel. So a lot of these bets that I'm taking are that the stocks might come down or the indexes might come down. The VIX, we saw this nice spike last week. We got in some nice trades that were engaging in an expanded volatility environment, and we are benefiting from that now because those trades are all coming into fruition, because the VIX is one of the few mean reverting assets that we have. It always comes back down into a non-correlated or a non-heightened market after a spike. US oil has been trading down very low in its current market environment, and the trend is definitely to the downside. I've actually got a slightly neutral position on now. And then gold, we talked about this already, but it's finally starting to drop down into the potential area where we would be back inside of its Bollinger Bands. Silver outside of its range as well, but again, point of control way down here at $41. Silver right now trading at $48 an ounce, so could come down quite significantly if the recent trend, the very, very recent trend continues. Apple trading at 263. We saw that reach all-time highs the other day, up 0.65% again today, so another all-time high. We've got the trade desks trading down in the bottom of its range. How about them Jays? Yeah, Jimmy Trader says, how about the Jays? Yeah, moving on, we've got what is it? Major League Baseball. I am so not a sports fan. Sorry, guys. I wish you guys were like, oh yeah, Levi's a sports fan. I didn't even know until this morning that the Jays were going on to the finals. So go Canada. Get that. Let's get that cup or trophy or whatever it is that they win. I guess it's been 32 years, something like that, since we've had the opportunity to have the trophy in Canada. So. I can't find, Terry's saying, I can't find an option chain for DVLT. I was just in general talking about some of these AI stocks, some of the stuff that's kind of on my radar, and, looking at some of those things and showing you guys that when we look at companies like that, even with the DVLT, where the stock is trading at $2.50, it may be a high risk trade. So we have to play those in a very specific way if we're looking for a swing to one side or the other. And typically I play on things that we have lots of opportunity on, like Arcade. We've got this as a technology ETF. Kathy Wood runs this, and we have an awesome opportunity. If I just pull up Moomoo, let's take a look at something like that, and I'll pull up some trades and ideas of how I might trade this market. So if I go to Arcade and I go to the options chain on this, I can go to the strategy builder. It will pull up trades for me, which is fantastic. One of the cool things that I like, if we look a month out, November 21st, we can see this expected move. Now this is in dollars. It's showing at 178, but we can also see that the short straddle's trading at $9.21 for that. We can plug that number in. So I can plug in the expected move of 921. And it will generate ideas that will show us where we might stay in range, like this short strangle right here. Selling the short 83 put and selling the 95 call collects a total premium of 470 bucks. And we can see that that's outside of the expected move. These are great little trades, and it is a nice environment to kind of play these because the volatility is slightly higher than average at 17.9, which it is today. One of the things that I like to do is take this trade and then place it onto the chart. So I'll look at these break evens, 99.70 and 78.30, and I will go to the chart and I will mark that on there. So we can just put a little line, a little trend line on here at 77.30, and we can decide whether or not that's a good break even on the downside. That's where the risk is in this market right now. Many of the trades that have upside risk are staying within it because the volatility is high enough that the stocks are staying in range. They're not moving up super quickly like they were earlier this year, but we don't know what's going to happen into the end of the year. There might be quite a surge to the upside. It's okay to play different types of trades. So if we go to that options chain, we can look at these positions. Well, let's see what that was. The strategy builder. This was the 83.95. And if I was going to place that trade with something kind of less generic than a strangle, then if I was selling that 83 and then selling that 95 and collecting a credit for that, what I could do is I could define my risk in some way. I can define the risk to the downside. This will significantly reduce my deltas, and it means that my profit to the downside, I end up in a position that still has a nice wide range, but I have no risk to the downside. So if I'm sitting in a portfolio that I currently have risk to the downside, I can still benefit from the decay of short options, but I can define my risk to the downside by putting on a spread that is less width than the credit collected. Now, in this case, the mid price is $3.01. So that means I can put an 83 put and an 80 put in play. And if I have to give back that $3, I'm doing it from the initial credit that I collect to open the trade. It means there's no risk to the downside. It gives me short deltas and has a high probability, 77% probability of profit. Short deltas, which is nice because that counteracts any other potential long delta I may have in my portfolio. I've got short Vega, which is not great for options volatility if we see an expansion, but we have no risk to the downside. So this is kind of a nice trade idea if you're looking for downside potential. The other thing we can do is put these slightly further out. We can buy these in December, the longer one. What that does is it really increases the profit 10 to the downside. You can see how that adjusted. Now the break even's at $71. We have much less risk to the downside, and it gives us a further delta, a larger delta to the downside, -30 in this case. Theta working positively for us at $8.08 per day. So this is a 31-day trade, and the expectation on this would be to collect somewhere between what we collect today, which is a $1.60 credit to open the trade. This one's actually showing at a $1.99 mid, but it is a pretty wide spreads on here. Not sure if we would get that. And if it dropped down, we would be able to sell off the long put at the expiration of the November 21st date. So these are nice little trades to put on that have that diagonal to the downside. Probability of profit 69%. Max profit marking at 507, but of course, if you change this IV, you'll see that this could actually increase the max profit. The IV increases when the stocks go down typically, and that's why we might play that. Terry wants to talk about RCAT, so let's take a look at that. Let's take a look at Red Cat. This is Red Cat Holdings, 1086. Wall Street's marking it as a strong buy, quant ratings a hold, valuations an F. So it means that it's overvalued right now. Profitability is a D-, but its growth has been great and its momentum is good. So it's electronic equipment, instruments. We can see we've got a whole bunch of analysts rating buy, September, August. Some of these are a little bit older, August. So we might have already seen the rise in this stock because in August, this was trading at $9.48, now trading at $10.86. So it's made about a 10% return over the last 2 months. If we look at the 1 month chart, we're actually trading at levels that are similar to the levels that we saw in September. And we saw that rise. In this type of case, what I would look for is I would go to a secondary source and I would say, let's go to investing.com. Let's look at RCAT holdings. And we'll see that fair market value of 1248, which is nice. This leads me to put on slightly bullish trades. We've got two different paid services that are both using their quant ratings to say, hey, we're looking at this and we think that there may be some slight upside to it, not massive upside. So how do we take a trade on this? Well, if we pop over to something like Moomoo, we can look at RCAT. We'll pull up that options chain. And we will pull in, we'll go to the strategy builder. And again, looking at that short duration, we can play these extremely short with a stock like this. The expected move is $1.43 over the next week. So if we were to plug that in, selling the short strangle, the 9.5 put and the short call gives us a potential profit of $65. The probability of profit is 66%. This is a nice little trade if it stays in that range. What's that range? 885 and 1265. Let's just look back at where this is right now and mark this on here. 1265 is this level right in there. And then, whoa, what did I do there? Let's do it on Trading View, just because we're RCAT, because we can. We're going to go to Red Cat Holdings. That 1262, if we thought that there was going to be a bounce back up, we can see the volume, that point of control around that 1027 level, which we saw this, lots of trading here, a little bit less trading up in these levels. That 1265 is here. It's inside of that Bollinger Band, which is a nice potential top. So I can put a mark there and then go down to the bottom. I'll turn myself off for a second, and where was that? 785 was the bottom, right? So that is the range of that strangle. If I thought that we were going to see a bounce and move back up to the upside, and I thought that might happen, what I could do with this is actually sell a slightly more aggressive put. So instead of doing the 1050, I can go to the chain and I can say, what if I sold the 10 position and collect 35 cents? This is a massive return when you think about what it is that we're getting. Sorry, that was the 1050. What if we sold the 1050, stocks trading at 1082. So I can't really go higher and still be out of the money. I have to stay at that 1050 strike. But if I wanted more room on the top side, what I can do is I can sell quite aggressively. Say I sell the 12, and then I can go out a further week and I can buy a 12 or a 12.5 on the top side. So I might buy a spread on the top side. I'm still collecting a massive credit. This is a $55 trade. So I'm collecting a credit of $55 to open. And if you look at the equity curve, we've got a really great profit profile. $9.90 on the downside, $14.17 on the upside. So if we go to my trading view again, we would then adjust this trade and say $9.95, where we are here. That's the downside break even, and then 14 something on the top side. People are often worried about it moving back up. So that is a potential trade that makes money if the stock moves up into this range. Pretty easy to adjust these. If you guys are looking for those types of trades, it's kind of a strangle. We actually call this, in my trading group, we call this a humpback. So what I'm doing is I'm selling a short duration, short strangle. So the October 31st, which is 10 days away, I'm selling the 10.5 and the 12 call, but then I'm buying a further dated, further out of the money, a long call. So that's 17 days to expiration. And you can see there's a little bit of a spread in there. So I'm paying about the same as I'm collecting in this case. If we were to look at the table, the November 21st, I'm paying somewhere around 45 cents for that, and for the November 7th position. And then for the selling the 12, I'm collecting 40 cents. So it's costing me about a nickel to get into that diagonal spread on the upside. And it really helps flatten that curve. It really widens it to the upside if you're worried about a potential recovery in some of these AI stocks. So hopefully that kind of helps you guys think about how I might manage these or how I might look at different things. What else do we have? Do you guys have any other questions about any specific stocks? I would love to pull up some other alternatives. I mean, obviously you could play this without the long call in November. You can just delete this off and you'll collect a higher price by selling both and collecting a full dollar. But the equity curve, the break even is much lower here at 12.97. The other thing we can do is we can do it on the downside. Diagonals technically work better on the downside. So if you wanted to take more downside protection, you go to November 7th and you might buy one of these 9 puts. Well, that will do the exact opposite. That'll give you a little bit of a more protection to the downside, moves this break even over to 944, keeps the break even slightly lower on the 1270. And if we get an IV expansion, right, watch what happens with the max profit. Right now, max profit's $81. If I expand this IV, there's potential of that making more money, depending on when the IV expansion occurs, of course. So these are pretty closely dated options, and it's one way that I like to set up a spread. If I wanted even more downside protection, if I wanted like a short delta position, which this one is, it's slightly short at -12, I would just pay for a tighter spread. And you'll see there's almost no risk to the downside in this case, collecting 40 cents to open. And if the stock goes down, the break even becomes very, very low because we have a tight spread on here, which makes much more money. And the probability of profit goes up considerably. Opening probability of profits is 69% with break even at 844. So that gives you a lot of downside protection. That is how diagonals are often set up, where we're doing that short duration about half the length of time of the longer duration. So in this case, 10 days and 17 days. We could go out even further. You can buy like the 14. This would give you even greater potential on here. But it costs more to enter. You're only getting 17 cents to enter this trade, which means that if the stock rallies, this break even on the top side is going to get hit faster. But again, we're buying these because we might think red cap might go down. So this is a short delta at 27. It's equivalent to buying or selling 27 shares of stock, which is interesting because you can actually neutralize that pretty easily. You could put this position on and buy 27 shares, and then you'd have a delta neutral position on, and that you would be able to adjust by buying or selling the shares as it moved up or down. Should they be all calls? It doesn't really matter. You can do either side if you want. So if we switch these to calls, you'll see that we end up on the same sort of profit profile. People often mistake that. They think that there's some sort of difference, but in the position of where we are relative, we can often replicate the same position. So in this case, what we're doing is we're selling 2 puts and we're buying a put. And so when there's 2 short and 1 long, we have a net short position. But if we were to do it with all calls, then we would be selling 2 calls, which are short positions. How do I say that? When they're all puts, it's a net short. It's a positive delta position, whereas when they're all calls, they're a negative delta position. We're looking at where this orange arrow is pointing right now. So watch if I switch it to all puts, you'll see what happens because we're selling more than we're buying. Now we have positive delta. So this is like a poor man's covered call setup, and we can do that with puts. It doesn't even have to be calls. It just depends on what we're doing, and then the alternate of it is to switch these and then reverse the selling or buying. And then we get into shorter deltas or longer deltas, depending. These are interesting trades too. If you thought that it wasn't going to stay in range, if you thought that it was going to really sell off, we're going to have a massive sell down, or we were going to make money to the upside. Typically, I don't set it up like that. If I wanted to get a long delta position, what I would do is I would do all calls, and I would sell the near duration calls, and then I would buy further duration calls, and I would just up the quantity of the further duration. This would give me a longer delta position, 0.39, give me a really nice profit tent. And even if RCAT went to the moon, I would make some money on this. But the idea with this is that I would be collecting this theta decay of $2 a day, approximately. This does have positive vega, which is nice on that position. So we're not getting killed if volatility expands, if that makes sense. But especially with butterflies, let's just set up a butterfly for a second. We'll delete this. So let's actually delete everything, and I'll just show you a butterfly, and then we'll look at puts and calls, because it kind of is an interesting thing. Say we wanted to put on a position 31 days out. We thought that our cat was going to, stay relatively close to where it is, and we wanted to put on a neutral position. And what I'm doing with this is I'm going to build a put butterfly, and we're going to look at that equity curve. So we have profit if it stays around that 1050 mark. It's trading at 1091 right now. So there's a nice big profit tent. We have limited loss to the upside, and that limited loss is about $30 in risk. To the downside, we have about $80 in risk, with potential of making $167. These are great trades. This is a great little trade for neutral trading. Well, what if we did the exact same thing with the calls? How different does it look? So let's just switch these over. You see there's a slight difference in the mid price, and this is where the spread is. So max profit is showing $85 because these would all be calls, and we're showing an $85 credit. On a stock that is liquid, in this case, we're only paying 33 cents for that. That shows that risk to the upside, $33 P&L. Really, it comes down to what we get filled for. So when we're building these, we have to take into account that we're not always going to get filled for the mid price. We actually may pay 50 cents for this. And then if we sell the calls, we may get filled for a better price than 85 cents. We may get filled for 90 cents or something like that. And that would reduce the risk to the downside. If we did it on SPX, you would see that they're very, very similar. So let's just do a search for SPX. Not Splenda. SPX index. And if we went to the options chain, we went to the table. Let's go to the strategy builder. You'll see that there's a long put butterfly right here and a long call butterfly. And these are going to have very similar setups. The shorts at 67.45, shorts at 67.45, the longs at 66.95, the long at 66.95. And you can see that the trade here, max loss 405, max profit 45.65. This one, max profit 45.70, max loss 400. They're identical trades. And this is because there's no arbitrage opportunity over the puts and the calls. So you're just building something out. The short straddle on this is showing a profit of 21,000. So where would we be? The move would be, the expected move, is it 215? No. Yeah, and then those butterflies disappear in that move. If we think that the move is going to be that large, if we're going to see the stock go up by the end of November at 69.71. I typically don't enter as straddles. I would start in a strangle type of position. This one's showing the 64.40, 67.50, which is very, very tight, but I would start slightly wider on the strangle and then adjust into a straddle. That's how I typically like to do it. Iron condors in this case, like you're getting 1/3 the risk of the profit, collecting up to $7,600. Max loss is 21,000. But this probability of profit is not great. This is not a good time to be selling condors because the likelihood is it's going to move outside of this range, and we're not getting paid enough because the IV index isn't high enough. The VIX is not high enough right now because there's not enough volatility because this market's been moving up. Which is a little bit unfortunate. So this is where we have to pick directional trades. We have to say, okay, well, I want a bullish trade. And it's why my supporters, my patrons, see so many diagonals being put on, because those trades have just so much more flexibility. We have the ability to move those trades around a lot more than a butterfly or a strangle, because the profit tent is wider, and that's because of the potential IV expansion that occurs if we do see a down move. I hope that makes sense. Okay, it is 11:30. I feel like there's not a lot of action going on, so we're gonna call that today. I'm also excited to announce, so we got a new cat, which has been kind of crazy. I took it down to Vancouver to get neutered yesterday. It was kind of a spur of the moment thing, so that's like my life has been flipped upside down. Haven't had a pet for more than a decade, and all of a sudden we got a cat in the house. So that's been kind of crazy. He's got the cone of shame on right now, so I'm not going to be able to introduce you to the new cat until he gets properly sorted out with his surgery stuff. So once he is settled, we'll bring him on, and we'll see if he can do some stock picking with me, because I kind of have some ideas for some shorts that I'm excited about, and I hope you guys are too, because I think that a lot of times when we're looking at statistical trading, we don't really need, you can probably hear him in the background. He's howling about something, but we don't really need direction in our favor. What we need is high probability trades. And if we trade enough high probability trades, there is a positive expectancy on the returns. And that's what I do, is I put on a whole bunch of trades and I do these adjustments so that we can make money, and hopefully people can learn from me and we can all get rich together. That's the idea. So thank you so much, everybody. We'll see my patrons on Thursday, and we'll see everybody else next Tuesday. Let's get rich. Take care. Bye.